Sean, we're going to go to you with story number 6. This is coming out of CNBC. It was a interview that occurred on CNBC during our lunch program. I went through, I watched the video, I sent it off to you, asked you to watch it. I'll read the headline, Arita. I'll give you a couple notes that I took about this discussion, John, and then I want you to comment on it. This is a solution that I think one startup is trying to provide to the marketplace as interest rates are going up, as mortgage rates are going up. So here is the headline, John, and then I'll give you a couple notes. Startup hopes to make home buying more affordable with assumable mortgages. And the gentleman who is the founder and the CEO of Rome, and if you want to go to their website, it's with Rome, R-O-A-M. His name is Renak Singh. He goes on to tell Kelly Evans and Tyler Matheson, he goes on to tell them about his company. And here's some of the key points. So what his company has done is they've created a website where they're looking for assumable mortgages. Anybody doesn't know what assumable mortgage is? Basically, it's any government-backed mortgage. It could be FHA, like first-time home buyer, or it could be something like a VA, somebody who served in the military. They come out, they qualify, the federal government is backing it. And according to the law, according to the interview, anybody who has an assumable or anybody has a mortgage that is government-backed, it can be assumable. So somebody can step into the shoes of the original borrower, take up their place, and be able to maintain the same interest rate. So if you get an interest rate back at 2 or 3% and it's government-backed, now theoretically you can come in and buy that person out, take over their home, and maintain that same 2 or 3% mortgage rate rather than having to pay 7.5% or 8% or even higher as to what it is today. A couple of things about this guy's company. One, they charge 1% of the purchase price. So if they're able to find you a deal, they're going to take 1%. The example that they gave is, say somebody bought a house for $380,000. They owe $300,000 now. And lo and behold, because of appreciation, the home is now worth $500,000. You effectively, as a buyer, could step in, you could assume the mortgage. You can come up with something very similar to what it would be like buying your own home. And this group, they have a secondary lender, somebody who can provide like a mezz loan or some second position to help you as an individual get in there and buy. And the point that this gentleman's making with his company, Rome, is that a lot of people don't take advantage of the fact that some of these mortgages can be assumable. And this might be a way to get around the higher interest rates and the mortgage rates that we're dealing with right now. So, John, I think I covered it all, but I don't know if you want to provide some of your banking expertise related to that.
Yeah, but why? You have to get the seller to agree to this. Why would a seller agree to this? It makes no sense. If this is a seller's market, why would you agree to basically allow the buyer to assume your mortgage? Because there are risks with that. And I think in some of the research that I've done, apparently you might still be on the hook for payments. If the buyer defaults, why even go through that hassle? There's a bunch of paperwork to do. Why not just sell a house for the cash? Or if there's a bidding war, who cares? Like, why go through that extra hassle? And what's more is most conventional mortgages are not assumable. This is only for VA and FHA loans. And that's just 15% of the market. So like 85% of conventional loans, you can't do this. You can't. And then why would a lender do this? It makes no sense. You want to get somebody into a loan with a much higher interest rate as a lender. You don't want people assuming 2% loans in this market. That's crazy. You'd be crazy to do that as a banker. So it just doesn't make a whole lot of sense to me right now.
Eric, let me ask you, according to the interview that occurred, roughly 3,350 assumable mortgages have been done this year. According to one of the stats that was referred to, I think it came out of the Wall Street Journal, but that was the conversation. The argument that the founder of this Rome company made is that people aren't aware of it. Therefore, they're not doing it. If we make them aware of it,
I think this guy is banking on the inability of many consumers to read beyond headlines and superficial text about seamlessly take on a 2% or 3% mortgage. This is your path to home buying. And then when you get into the fine print and start looking at the details and the contingencies and the potential repercussions, as Jean pointed out, it dies on the vine as something viable. I agree with you as far as the seller's point of view, especially in a market like here where inventory is so tight that if you're putting your home in the market, you're still getting demand, organic demand, without all these contingencies involved to be able to complete a sale. So it doesn't make any sense to me on the seller side. And I think these days consumers are so much more educated. they're also smart about getting the third-party experts to advise them in a traditional real estate transaction that there's not going to be a mass market for a product like this, because once you start peeling back the layers, it just stinks.
And you're going to start seeing these kinds of things being pitched because affordability is so difficult. So you're going to start seeing all kinds of weird stuff like this that you would not see
If
in
you're
a
going to tell me it's a
normal
seller
market,
financing product, then I could get there. But yeah, the assumable 2%, 3% loan with this Rome company getting a nice VIG. It's hard to make sense of that.
I will say, just to conclude this particular discussion, I took a look at the 10-year treasury coming in at 4.55. If you say 3%, add 3% for a mortgage coming in at 7.5 or so. This guy from Rome, the founder, says you can typically use the second mortgage, you blend it with the first mortgage, and you're paying half.
Give me a break.
You're paying half of what you would be going if you were new money coming in.
So you got to get a second mortgage.
You need
That's
a cap and a stack to
Well,
buy a home. It's crazy.
Yeah.
What a hustle.
Yeah.
Mr.
This reminds
Fakler.
me of 2006.
So so you're talking about Ninja? No income, no
No, you
verification?
remember people were stretched so thin in like 2005, 2006. They had to get 2 lenders to like make it work.
Mr. Fakler, final thoughts before we shut down this podcast.
We've been doing a lot of talk about the cost of real estate. I came to Miami in the late 80s. Miami used to be cheap. You could buy a condo for 35 grand on the beach. And just to see how things have blown up over the years is stunning in a way, because I don't think you see this in any other part of the country. Again, also the fact that the deals are 40%, I believe I read recently, are cash deals. In the rest of the country, that number is more like 27%. So you have a lot of different reasons for that, but it's still a cash buyer's market, and will probably continue to be so in the future.